Greetings to everyone watching the video. My name is Alima Chimthanawala, and the topic on which I have made my paper is a study on impact of currency rate fluctuations on performance of Indian stock market. The introduction of my paper is the advent of the floating exchange rate in 1973 has reforms of financial markets in the early 90s. The Asian currency crisis of 1997 and 98 and the 2008 economic recession have collectively made a strong pitch for the dynamic linkage between the stock market and the foreign exchange market. Traditionally, both the markets have been regarded as sensitive segments of the financial market, as the impact of any policy change gets quickly reflected in these two markets. At the same time, ruptures in either or both the markets tend to raise concern among the policymakers. That is, the two markets have tremendous policy implications. Clubbed with these, the dynamic interrelationship between both the markets has prompted researchers, policymakers, as well as the analysts to carry out detailed analysis of this relationship. There is still no consensus on the relationship between the stock market and the exchange rate, although the topic has been widely discussed. Financial theory also explains that the value of firms should be influenced by exchange rate and interest rates. In India, foreign direct investment, that is FDI, is an important element of stock prices, and the trend of FDI may considerably be affected by changes in exchange rate, either depreciating or appreciating. Similarly, the exchange rates are affected by the movements in stock prices. In this context, the study is motivated to examine any such linkage in Indian context. Now, talking about the exchange rate, foreign currency exchange rates measure one currency's strength relatively to another. A strong currency is considered to be one that is valuable, and this manifests itself when it's comparing its value to another currency. The strength of a currency also depends on a number of factors, such as inflation rate, prevailing interest rates in its home country, or the stability of the government, to name a few. Exchange rates are classified in two types: fixed exchange rates and floating exchange rates. Talking about fixed exchange rate, a fixed exchange rate uses a steady reference point to quantify the worth of currencies. Gold has always been used as a benchmark for this. This is due to the fact that it is valuable commodity on the global scale and its value is less affected by interest rate swings. Until the mid 19th century, the method of connecting money values to gold worked pretty successfully. The gold standard system in the early 19th pegged the value of gold at US dollars 35 per ounce of gold, which was the reference point those other nations used to fix the value of their currencies. It is important to note that this price was not commodity price of gold. Private investors could not purchase gold at this price point. Government had also exclusive rights over private individuals to buy gold at this below market price, thus reducing the volatility of currency values. Eventually, the practice became quite unsustainable due to placing unrealistic demands of the inflation of the US dollar. So, in 1994, the gold standard was abolished and was replaced with the pegged exchange rate, which is also known as floating exchange rate. The pegged exchange rate system combines the element of floating and fixed exchange rates. So, smaller economics are more vulnerable to currency changes, thus, often peg their currency to single major currency or a basket of currencies. These currencies are chosen based on which countries the smaller economy does a lot of trade with, or the currency in which the currency's debt is demonetized. For example, if a small nation that does a lot of business with the United States decides to peg its currency to the US dollar, its currency will fluctuate in value in a similar way to the USD. The method eliminates large scale swings and makes the currency of the smaller economy a safer investment. Larger economies um, are less hesitant to enter into trade agreements with such currencies because their value is unlikely to change much. Such systems have been shown to lessen currency volatility in developing economies and to put pressure on governments to be more disciplined in their monetary policy decisions. However, this opens the door to investor speculations, which could have an impact on the currency's value. Once the weaker currency gets momentum and sees its true market value rise considerably ahead of its pegged value, fixed rate schemes may be abandoned entirely for this. There are few factors that also affect the exchange rates. For example, first would be inflation. Typically, a country with a consistently lower inflation rate exhibits a rising currency value as its purchasing power increases relative to other currencies. During the last half of the 20th century, the countries with low inflation included Japan, Germany, and Switzerland, while the US and Canada achieved low inflation only later. Uh, those countries with higher inflation typically see depreciation in their currency about the currency of their trading partners. Another would be strong economic performance. Foreign investors inevitably seek out stable countries with strong economic performance in which to invest their capital. A country with such positive attributes will draw investment funds away from other countries perceived to have more political and economic risk. Political turmoil, for example, can cause a lot or a loss of confidence in a currency and a movement of capital to the currencies or more stable currencies. So these are few factors that affect the exchange rates. Now, review of literature. To examine the impact of exchange rate changes on stock markets, Frank and Young's in the year 1972 was the first study that investigated the relationship between stock prices and exchange rates. They used of 6 different exchange rates and found no relationship between these two financial variables. Then in 1987, Solnick examined the impact of several variables, exchange rates, interest rates, and changes in inflationary expectations on stock prices. He used monthly data from 9 Western markets, which included US, Japan, Germany, UK, France, Canada, Netherlands, Switzerland, and Belgium. He found depreciation to have a positive but significant influence on the US stock market compared to change in inflationary expectations and interest rates. In 1989, Taylor and Tongs also studied the impact of the abolition of the UK exchange control on the degree of integration of the UK and its overseas stock markets such as West Germany, the Netherlands, Japan, and the US. Objectives of the study includes to examine the relationship between the performance indicator of Bombay Stock Exchange, Sensex, and the USD. To understand the overall approach, what is the approach in the relationship between both the variables, to understand what are the exchange rates, to also understand what factors or the impact exchange rate has on the currency, to also understand the forex exchange market from a global as well as Indian point of view. The hypothesis of the study has first, there is no significant impact of the USD INR rate fluctuation on the Indian stock market. And another would be there is a significant impact of USD INR rate fluctuation on the Indian stock market. There are as well as few limitations of the study. The data for the analysis is limited because it is not possible to get the data for overall all the other currencies. And the main limitation is the time limit, because the whole fundamental analysis required more time. But due to the time constraint, only one currency is taken, that is USD. That's why the project is time bounded. Now, there is a correlation between USD and BSC Sensex. From the chart given here, we can interpret that there seems to be a slight positive correlation between USD INR prices and the Sensex. The value of R is 0.12, which means that for the period of 1st April 2020 to 31st March 2022, the USD INR rate has accounted for 12% of change in the value of Sensex. To test this hypothesis, regression analysis was applied to the data. The data of USD and Sensex was collected for the period of 1st April 2020 to 31st March 2022. From the result of the output, we can see that the regression coefficient is not zero. Therefore, we reject the null hypothesis and accept the alternate hypothesis, which says that there is a significant impact of USD rate fluctuations on the Indian stock market. The regression model may be stated like Sensex is equal to 134,305.3392 minus 1,167.613356 USD INR. From this paper, the conclusion that we get is performance of the stock market plays an important role in the economic situation of any country. On the other hand, fluctuations in the country's exchange rate are also likely to influence the performance of the stock market. In our study, we have investigated the impact of currency fluctuations and the Indian stock market. And for that, we have worked on to find the relationship between exchange rates and stock market performance in BSC using monthly adjusted data for the period between April 2020 and March 2022. Three foreign currencies of the major development partners and players in the region were considered. That is the United States dollar. The stock market performance was measured using the major stock market index, that is BSC. We applied the linear regression technique in order to find any existence between both the markets. Through our study, we found out that the relationship between volatility of USD with Sensex was slightly weaker than expected. The recommendation that we would give is these findings have several implications. One is that the domestic firms in India are exposed to foreign market stocks and risks that hit the major foreign currencies like the United States dollars, the British pound, and the euro. And these stock will in turn have lasting impact on the performance of stock market. The policymakers must therefore formulate appropriate monetary policies that would not only facilitate the development of stock market but also secure the stock market against the external shocks. Secondly, curbing swings in the exchange rate would help attract new investments and also sustain existing ones, thereby encouraging growth. Additionally, firms listed in should also consider adopting more efficient hedging instruments to ensure the elimination of negative effects of volatility in Indian stock markets. This is all from my side. Thank you so much.